Cypress Financial Group presents the Retirement Roundtable podcast with John Scallan. Get more at cypressfinancial.net. Now, let's get to the show.
Let's get rolling, buddy, because, John, even though President Trump has paused most of his planned tariffs for now, we're still seeing volatility in the market. This was on Fox Business. They asked J.P. Morgan's Jamie Dimon if he's expecting a recession.
I think probably that's a likely outcome. Markets aren't always right, but sometimes they are right. And I think this time they are right because they're just pricing in uncertainty at the macro level and uncertainty at the micro level, the actual company level. And then how it affects consumer sentiment, it's hard to tell. Consumers still have jobs. Wages are going up the low end, which I think is a good thing. But if companies start cutting back, the consumer sentiment changes and business sentiment changes. No one's wishing for that, but hopefully if there is one, it'll be short.
It does seem like the R word, John, recession, is starting to pop back up into the headlines and into the financial news channels. So when somebody calls you and they're worried about a potential recession, John, how are you reacting?
I do appreciate Jamie Dimon's perspective. He's a really smart guy running one of the biggest and most profitable organizations in the world. But I always want to remind our clients and our listeners today that even the top economists have a pretty poor track record when it comes to predicting recessions. Listen, in 2020, when inflation was really running out of control, there was some really, really smart people that I've followed for decades, people that incredibly smart. They were flat out wrong. So what's more important than trying to time the market is having a plan that can weather economic downturns when they inevitably occur. We often talk to our clients. It's not if winter is coming in the market, it's when. So for clients who are worried about recession talk, we really focus on preparation rather than prediction. Jamie Dimon mentions uncertainty at both the macro and the micro level, and that's exactly what a strong retirement plan addresses. As for delaying retirement due to these headlines, I'd be very cautious about making such a significant life decision based purely on recession forecasts. I had a client who was all set to retire a few years ago. Then he got spooked by those same predictions in 2020, and he really considered working another year. Fortunately, he stuck with his plan and he retired soon after the market had recovered all of its losses and then some, meaning he almost worked more than he wanted to for essentially no financial benefit.
Okay, I want to play devil's advocate here for just a minute, John. So if somebody's retirement portfolio takes a 20% hit right before they retire, that's going to impact their long-term plan, right? So wouldn't working another year or two help offset all of that damage for that gentleman?
Mark, I tell you, that's a fair point. The sequence of returns in the early years of retirement can definitely have a significant impact on a portfolio. But that is exactly why we build plans with these scenarios in mind. For clients within, say, 5 years of retirement, we generally recommend having 1 to 2 years of income needs in cash equivalents and another 3 to 5 years in conservative investments. What this strategy does, it creates a buffer so you don't have to sell stocks during the downturn. Again, we talk about this incredible piece of software, this financial planning tool called the Retirement Analyzer. This product can actually stress test your portfolio against historical scenarios, such as 2020, such as the pandemic, such as the 2008 Great Recessions that people would potentially face in early retirement years. What this does, it helps us determine if your plan is robust enough, if it's strong enough, or if adjustments might need to be addressed. So listen, if you're getting close to retirement and losing sleep over market swings, try this safety cushion approach. Figure out your expected monthly spending in retirement, monthly. Then multiply this times 12 months, 24 months, 18 months, and then just consider keeping that amount of cash or in very safe investments. This money buffer, can help you avoid having to sell investments during market downturns, and it actually gives many of our clients peace of mind during these uncertain times.
If we decide to put that money in cash, could we be missing out on some potential growth?
Mark, that's again, very, very valid point. But remember, there are always trade-offs. Remember, the goal in retirement isn't about maximizing returns. We don't sit across the table from our clients moving into retirement and say, hey, let's try to get 20%. What these strategies are about, it's ensuring that you don't run out of money. Think of it as, let's call it insurance against having to sell investments at the worst possible time. For anyone out there, any of our listeners concerned about a potential recession and how that may impact their retirement plans, just give us a call. 504-732-1001. We will run your specific numbers through our retirement analyzer and show you how different scenarios might affect your long-term outlook.
John, I love how you said that. We prepare, we don't make predictions, much like the weather in southern Louisiana. You can't predict what that storm is going to do, but you can definitely prepare for it. It's the same thing with a recession. None of these talking heads can predict that a recession will be here at this day and time, but what John can do, he can help you prepare for it. It begins with a phone call to 504-732-1001. It's a retirement analyzer. This weekend, if you've saved at least $300,000, $400,000, $500,000 or more, and that's really where the power begins to start building upon your gains in your retirement portfolio, that retirement analyzer. It's no cost. It's no obligation. 504-732-1001. We invite you to call today. We invite you to call this weekend. Even if you just need to call, hang up to lock the number in. We got a call last weekend, and a gentleman said, I just need to save the number. I'll call you back on Monday. And sure enough, call back on Monday, talk to John and the team, and they got moving. But we invite you to call 504-732-1001. We're always available at cypressfinancial.net. And John, let's talk about those three letters which cause a lot of drama, some anxiety, but it's a reality of retirement. And we're talking about RMDs, required minimum.
I thought you were going to talk about those other three letters like the IRS.
Oh, that's another.
RMDs. Yeah, RMDs are not as emotional than those other three.
Because at least with the RMDs, you can, as we talked about, you can prepare for that. The RMDs coming. Basically, Uncle Sam wants his tax money. And that's why retirees pay the RMDs on all tax-deferred accounts. And that begins at the age of 73. So, John, the government gets its share. But do we have a choice on how we can schedule our RMDs, our required minimum distributions?
Great question, my friend. And yes, there is actually quite a bit of flexibility when it comes to the timing of your RMDs. The IRS, there's that three-letter word, only cares that you withdraw the required amount by December 31st each year. How and when you take it, it's totally up to you. Some clients prefer to take their RMD as a lump sum early in the year. Their thinking is, let's get this obligation out of the way. You know, others prefer monthly distributions to supplement the regular income. And some people, like my mother-in-law, they wait until late in the year, maximizing tax-deferred growth for as long as possible.
Does the timing make that much of a difference? I mean, if we're talking about the same amount of money and the same tax bill, either way, what does timing have to do with it?
Well, it depends on your situation. I mean, that's really the bottom line. I mean, you and I talk about this every week. Every financial plan is unique. Every situation, different goals, different dreams, different commitments. So again, it all depends on your situation. For some people, the timing can have really meaningful tax implications. For example, if you know your income will be lower in the second half of the year, it might make sense to delay your RMD until then. There's also the market timing aspect to consider. By taking monthly distributions, you're essentially dollar cost averaging out of the market. We think about dollar cost averaging as putting money into the market. So again, at Cyprus, we look at your overall tax situation. This helps us determine not just how much your RMD will be, but also what's the most tax efficient way to take it.
If somebody calls you, they have more questions about RMDs, but they're already working with an accountant, wouldn't they be handling this kind of tax planning already?
Well, let me say this. We are never going to represent ourselves as as a qualified CPA. We will work with you and help you communicate these ideas to your CPA. I mean, look, let's face it, many accountants are fantastic at tax preparation, but they're often looking in the rear view mirror. They're reporting what has already happened last year. True comprehensive tax planning is a forward-looking strategy, and it integrates with your investments and retirement strategy. Again, great North Shore couple, been working with them for a long time. Our initial meeting, they said, look, we have several income sources: Social Security, a small pension, some rental income, and their RMDs. When we really sat down and talked about it, we realized that by really coordinating all of these income buckets, for lack of a better term, when they sold appreciated investments with their RMD timing, we could significantly reduce their capital gains tax rate. It wasn't about when they took their RMD during the year, but rather how their RMD planning worked with their overall tax strategy.
Probably should have led with this one at the beginning about RMDs. There's no getting around RMDs.
100%. Listen, there is a table. Let's just say, for instance, you hit 73 years old. You had $300,000 in your IRA account. Again, I don't want to go too far down the rabbit hole, but you take that $300,000 and you divide that by 26.5, that's actually going to give you your RMD amount, $11,320. That's all you have to take out of this $300,000 bucket of money. The next year, that number goes down a little bit. What the IRS is actually doing, they want you to take a little bit more each year so that eventually you're going to get all of your money out, and Uncle Sam's going to get all of their tax money.
John, we're just exhausted by RMD. 3 letters: IRS, RMDs. We need a little TLC, maybe put on some old school REM, and let's just see what happens. And we want to get more about how to mitigate our taxes in retirement. How can we reach out to you and the team at Cypress Financial?
Again, easy to find us, 504-732-1001. We're on Causeway Boulevard in Metairie. We're on Florida Street in Mandeville, both sides of the lake. We certainly talk to people by Zoom. We make house calls. We meet people at their place of business. Whatever works best for you. Where can you be most comfortable, confident to really start this process of getting you ready, getting your family ready for this next chapter, which could arguably be the best chapter of your life? We're here to help. We'd love to be part of that journey with you.
504-732-1001, 2 convenient locations of Cypress Financial to meet you at a time and a place that fits you and your schedule. We invite you to call today. Again, 504-732-1001. John, there was an interesting comparison that I heard. When a movie comes out, you can go to the theater or wait until it hits streaming. Now, the film industry is pushing to keep movies in the theater longer because they believe they can make more money before releasing them on the streaming services. John, that's kind of like Social Security. You could claim benefits at age 62, but it pays to wait. Do you find that some people are too quick to stream that Social Security income? They want that access now without thinking about what it could be later?
Yeah, Mark, terrific analogy. And yes, I do see many people rushing to claim Social Security as soon as they are eligible without really fully understanding the long-term implications. For each year that you delay claiming beyond your full retirement age, which is 67 for most people now, your benefit increases by about 8%. That's a guaranteed return you really can't find anywhere else. I was meeting with a gentleman and his wife recently who was, the gentleman was adamant about claiming at 62. His exact words were, "I want to get it while the getting's good." He was convinced Social Security wouldn't be there later, but we sat down with him. We ran the numbers through our Social Security optimizer. He was shocked.
So what do you say to the people, John, that come to you and they say, look, I've been paying into Social Security for decades. I want to start getting that money back as soon as possible. I mean, they make a good point, because if somebody claims at 62 instead of 70, that's 8 years of benefits they're receiving, while the person who waits potentially gets nothing.
You're absolutely right again, Mark. And that's the exact calculation that people need to make. The break-even age, when the person who waited starts to come out ahead, typically that's in your late 70s. Here's the question. How long do you expect to live? If someone is in poor health, or your family history suggests a shorter lifespan, or if you simply need the money, claiming early might make sense. But with life expectancies increasing, many people will live into their 90s, making this delayed strategy the better financial choice. Mark, one other thing, it's worth noting that for married couples, the higher earner's benefit becomes the survivor benefit when one spouse passes away. You could potentially be providing a larger lifetime income for your surviving spouse. And just one quick task I really encourage everyone to do this week: set up your personal Social Security account at socialsecurity.gov. You can also get there at ssa.gov. It only takes about 10 minutes and it's completely free. You will see what you're projected to get at different ages. Plus, it gives you the opportunity to check and see if your work history, how much you've earned every year, is recorded correctly. Listen, we've seen several cases where earnings weren't properly recorded, which can really hurt your benefits. Much, much better to catch these issues now than when you're in the heart of retirement.
John, there's a lot of people that are saying, well, there's all these conversations about Social Security. It could go away. It could be gone in 8 years. So what do you tell those people who are almost want to throw their hands in the air and say, like, well, I need to get it while I can because I don't know how long it's going to be here. So I'm going to go ahead and start taking the benefits early.
Mark, that's a concern that many people share. But the reality is that Social Security is incredibly popular politically.
Yeah.
And major cuts to these benefits for those at or near retirement, just from my perspective, are highly unlikely. You know, what I tell most of our clients is make your claiming decision based on your current rules and your personal situation, not on speculation about potential future changes. And remember, Social Security is just one piece of your retirement income puzzle. Our Social Security Optimizer service can show you all of your claiming options and help you make a more informed decision that really helps you get the most out of this maximum lifetime income benefit. Again, if you'd like to take advantage of this complimentary service, please call us 504-732-1001. It would truly be a pleasure and a privilege to meet you and talk about what retirement looks like for you.
Investment advisory services offered through Cypress Financial Group, a registered investment advisor firm. Registration is not an endorsement of the firm by securities regulators. By contacting us, you may be provided with information about insurance products, including annuities offered through Cypress Financial Group, John Scallan, Louisiana Insurance License Number 1064997. The firms are separate entities. Annuity guarantees rely on the financial strength and claims paying ability of the issuing insurance company and are not offered by Cypress Financial Group. Read your contract for restrictions, limitations, or penalties.